In this week's video, we'll review the latest charts to help us answer the question, will surging energy prices usher in a recession and bear market? We'll be moving quickly, so feel free to use the pause button on your video player. We'll open with Friday charts and then switch gears to a segment that was recorded Thursday and then back to Friday. S&P 500 daily as of the close on March 4th. Still relevant, this nice looking powerful buying power candle here, also relevant. This push thus far has been so weak it has not made it back to this downward sloping trend line. It's obvious here we're still in a downtrend. MACD's somewhat of a mixed bag. Below zero on the daily chart, but black above red. It's going to be a common theme here. Mixed bag. The good for the VIX. This high here, this intraday high, was lower than the intraday high that was made on January 24th, even though the S&P 500 printed a lower low. That would be the positive side of the coin. The negative side of the coin is the VIX remains in an uptrend. If you're a stock market bull, you'd really like to see this trend line broken and, more importantly, this trend line broken. Friday's close was still well above this intraday low here and also above the June low. NASDAQ 100 30-minute chart, obviously still clearly in a downtrend. That would be the bad news. The good news would be well above this intraday low that was made on March 24th. And we've also got improving momentum here. This dotted line here, you can see price is basically in the same area here and here. RSI way down here and way up here during Friday's session. This is a setup. Setups need follow through, and that would fall into the to be determined category. NASDAQ 100 also closed well above the intraday low here and near the 50% retracement of this A to B move. We're looking at IEF divided by SPY. You can make an argument that this is a left shoulder, this is a head, this is a right shoulder. That would be a bullish pattern. If this ratio moves in this direction, if you're a stock market bull, you really don't want to see that. That's the COVID spike in fear. Not too much damage here, but enough to pay attention. If we looked at TLT divided by SPY, it looks a little bit better. Here's the March 2020 low. You can see this looks different on this chart here. It's not an encouraging sign until it is repaired. Covered this back on January 14th, our hypothetical 4 to 15% drawdown from this closing high here. You can pause your video player here. Just remember the 9%, the 11.83%, and the 14.3% as covered in a previous video. Where do we stand as of the March 4th close? We're still in the blue box that we've covered previously. Keep in mind, this is an intraday low here, so we could still stay inside of this box and get a closing low down in this area here. When you're down here intraday, your drawdown's about 14.22% where my cursor is. On a closing basis here, 11.91%. Both of those fall within this range. Friday's close still above that June low that we referenced last year several times. And these fibs, these dotted lines, also represent areas of possible support. Sentiment is also a setup. We need to see some follow through relative to that. This chart goes with this tweet. Also relevant. Sentiment similar here to this point here. Here we have a divergence with RSI. And here, thus far, we have a divergence with RSI. Thus, we have two setups in the present day that are similar to this period in here near a major low. Those are setups. We need the follow-through. Covered this chart in the past. You can pause your video player. All things being equal, if you're a stock market bull, you really don't want to see a close down here. You'd prefer to see something like this or this. This tells us to keep an open mind about more downside. Now let's review some historical data related to the energy markets and the stock market and see what we can learn. This portion of the video is being recorded on Thursday evening, and at this point it's been 6 trading days since Russia invaded Ukraine. And from an energy perspective, there's two ways to look at these stats. Russia is the supplier of about 10% of the world's oil and more than 15% of its gas. Said another way, 90% of the world's oil supply remains intact, and approximately 85% of the supply of gas remains intact. Tweet on the right side of your screen from this week, here's the source. Brent's 6-month calendar spread is signaling a severe shortage of oil as sanctions cut off exports from Russia. The spread is currently traded in a backwardation of more than $13 per barrel. Last time backwardation was this severe was September-October 1990, after Iraq invaded Kuwait. Thus, it might be helpful to look at the price of oil in 1990. Similar to the present-day situation, oil spiked quite a bit higher during the Gulf War in 1990. Tweet on the right side of the screen references this period here. Last time backwardation was this severe was September-October 1990. September-October 1990. Now, we might think that with a 6-month calendar spread signaling a severe shortage in oil, the prices from this point here, which is similar to the present day in terms of backwardation, would continue to spike higher. But that's not what happened. Here's the period here, similar to the present day on the right side of the screen. After oil peaked, it dropped 58% from the intraday high here to the intraday low in 1991. Common sense tells us that a spike in energy prices can occur when we see shorter-term supply disruptions. The million-dollar question is, how long will a supply disruption last? And we always have to keep in mind, in any market, if oil can rise very, very rapidly, it can also fall very, very rapidly. Not a prediction in the present day, but it's good to know what happened relative to this information over here. How about the economy and stock market? Well, the answers to those questions will help us keep an open mind about worse than expected outcomes. In this case, we did get a mild recession from July 1990 to March of 1991. The stock market had a pretty significant drawdown. Peak to trough on a closing basis, it was 19.48%. Another question that might be helpful to ask and answer. Viewed in isolation, is it possible for crude oil to spike in a significant manner and for the economy to avoid a recession? And is it possible for the stock market to produce respectable returns when we see a spike in oil prices? From April 1st, 1986 until year-end 1986, crude oil gained 81%. Full-year performance for the S&P 500, 1986, 15%. Looking backwards from April 26, 1989, oil had spiked 78%. Full-year performance S&P 500, 1989, a gain of 27%. Year-end 1996, this point here, looking backwards, oil had gained 52%. Full-year performance for the S&P 500, a very respectable 20%. October 25th, 2004, oil spiked 73%. Full-year performance 2004, a gain of approximately 9%. Calendar year 2005, when we look backwards, August 30th, 2005, right here, crude oil spiked 72%. S&P 500, still fairly respectable performance for the full year in 2005, a gain of 3%. S&P 500 major bottom calendar year 2009-2010, looking backwards from January 11th, Q1 of 2010, oil had spiked 110%. Was the stock market doomed in 2010? No, it returned a respectable 13% for the full year. Looking backwards from December 12th, 2016, oil had spiked 109%. Full year performance for the S&P 500, approximately 10%. May 22nd, 2018, looking backwards, oil gained 73%. Stocks down for the year, down 6%. But given the fact that the S&P 500 has already had approximately a 10% drawdown year to date for the full year, this type of performance really doesn't look that bad. To summarize these anecdotal cases, in the 8 cases we just covered, the average gain for crude oil, 86%. The median gain was 75%. Stock market doomed for the full year? Absolutely, positively no. Average gain in the S&P 500 in these anecdotal examples, 11.28%. The median gain for full year was 11.16%. And at some point during the calendar year, crude oil had gained 86% on average. The median gain was 75%. Did that automatically mean we were going into a recession? Not in these 8 cases. In every single case, the S&P 500 avoided a recession in the calendar years shown. What's the takeaway here? Very, very simply, viewed in isolation, a spike in crude oil of 86%, 75% doesn't necessarily mean a recession is on the way. NAIM Exposure Index speaks to risk aversion. Recent reading around 30%. This is a form of sentiment. So the good news would be pessimism here, major bottom in the stock market. We're here now. Similar situation here. Major bottom in the stock market in close proximity. That would be the good news. The bad news would be a reading like this doesn't necessarily tell us that we're going to avoid longer term something like this in 2007 and 2008. For example, we're down in the same general area here, and yes, eventually the S&P 500 had a strong counter-trend rally here, but then it resumed a downtrend. This helps us with maximum flexibility. It's possible that this look here could morph into something like this or this. It's also possible that this look here could morph into something like this over here. A lot of bad news recently. Russia, Ukraine, huge spike in energy prices. Still seeing extremely high inflation readings, and we have a Fed that's getting ready to tighten policy. Thus, it might be helpful to ask and answer. Have we seen a huge spike in credit spreads? Well, thus far, the answer is no. Credit spreads as of March 2nd. Here's that fear spike during the COVID plunge in the S&P 500 associated with a recession. The shaded area. Present day. Credit spreads have come up a little bit, but this is hardly alarming at this point. As we've mentioned several times, credit spreads can move very, very quickly. Thus, it's possible they will move very, very soon, but they haven't moved yet. What about the most important pair in the yield curve relative to predicting recessions? It's the 10-2 yield curve. So this is the 10-year Treasury minus the 2-year Treasury, and we're talking about yields here. Yield curve inversion is when that number goes negative. You can see the shaded areas. Inversion can come near recessions. Inversion, mild recession, or at least short-lived here. If we zoom in on the same yield curve as of March 3rd, is it inverted yet? It is not inverted yet. Is it getting closer? It is. Is this something we should be concerned about and or pay attention to? Yes. But at this point, we do not have yield curve inversion. At this point, the yield curve is not jumping up and down, waving its arms, screaming recession. Yes, we've dropped a little bit here. We also dropped a lot over here. We didn't move into a recession for quite some time. We're down in the same general area we are today in 1995. If you know your stock market history from 1995 to 2000, one of the greatest bull runs in our lifetime. Recent publication from the Federal Reserve Bank of St. Louis, dated March 1st, 2022. Another example of something that's not jumping up and down and waving arms relative to an imminent recession. In sum, the most probable outcome for 2022 is 3 to 4% real GDP growth. Back to Friday. Employment data, you can pause your video player. Probably fair to say that recent data and the headlines on your screen align more closely with this bullish leaning look here relative to this bearish leaning look here and or here. Very, very similar situation, industrial production, and now we're talking about recession probabilities. ISM last reading, 58.6. A reading of 50 or higher indicates growth. When these numbers drop below 50, concerns about a recession start to increase. You can see we drop below 50 here and here, and this is the COVID recession. This is the present day. Also speaks to recession probabilities. Covered this many times. Chicago Fed National Financial Conditions Index does not look recessionary at this point. And we know that historically S&P 500 drawdowns tend to be more muted if you can avoid a recession, and the other side tends to be very, very favorable if you can avoid a recession. The major indices are still holding the buy the invasion low, whether or not that turns out to be the low. That's in the to be determined category. Always important to think about the other side. Very, very easy to focus on a drawdown like this and not think about the longer term. In this case, that would have been a mistake because the gain from point A to point B in the S&P 500 after this waterfall decline was almost 48%. So look at the credit markets as of the close on Friday, March 4th. Starting to show a little bit more strain. This is a pay closer attention look, just as this look is down here. If you're a stock market bull, you'd prefer to see this hold and or this hold. Great study from NDR here. Here's the Twitter handle where my cursor is. What it basically tells you is oil performance around global oil market disruptions. You tend to get a big spike. And then the average move after that, from here to here, is about a decline of 30%. Not a prediction, just good to understand stock market and oil disruption history. Quietly, interest rates are starting to come down a little bit, and we all know that can impact stock market leadership. Noteworthy on March 4th, growth outperformed financials, and that may speak to interest rate expectations. Showed this chart in the past, all things being equal, you'd prefer RSI to hold here if you're a stock market bull. We really didn't do it. This looks weak, and this is also a be open to additional downside look until this can be cleared up. Covered this chart in a previous video. This also is an additional downside look. This look here hugging the band looks more like this here than these reversal looks. If you look at RSI from this perspective, it helps us keep an open mind about better than expected outcomes in the S&P 500. NYSE Composite as of the close on Friday, March 4th. Right now, this looks like a failed bearish breakdown look, but it is still vulnerable to losing this long-term consolidation box. Stock market breadth has not shown much of anything. Bad news. Break this consolidation here. Potentially good news. A falling wedge look here tells us to keep an open mind about a reversal, but that's a setup. This is the chart in front of us. This potential resistance here, potential resistance here, and potential resistance here, what once acted as support may now act as resistance, also speaks to interest rate expectations. We'll see what happens at this key level here. It's possible with the spike in energy prices that we're going to see a breakout in this direction. If you pause your video player, this also speaks to interest rate expectations. Thus far, the trend is holding. Talked in the past about inflation expectations becoming somewhat muted in terms of momentum. Bullish momentum seems to be back on track. Is that good, bad, or indifferent? Well, we know the stock market and a lot of sectors got weak in November, so this is when expectations started to lose momentum. And if you pause your video player here, most declines in the stock market are deflationary events. Most declines in the stock market, they tend to be deflationary events. Very, very difficult to say that the chart on the right looks like the chart in the center and the chart on the left. Bottom line, present day is a different animal relative to this period and this period. Has ARK shown anything? Answer, not yet. Not unusual for a parabolic advance to retrace the entire advance. You can make an argument that we're in that area now. Also speaks to interest rate expectations. This is value versus growth. This is a monthly chart, and this is as of the end of February. The breakouts on the energy charts are telling us to keep an open mind about a breakout from this W formation. A lot of these charts are hard to believe. It is hard to believe that value has not broken out of this consolidation box relative to the S&P 500. Again, the energy breakouts on relative charts are telling us it may break out very, very soon, but it hadn't happened yet as of the close on March 4th. This one looks a little bit more bullish using VTV and VUG. And this look also tells us to keep an open mind about a breakout. Why? Rejected. Rejected, rejected. Notice here, this is a little bit of a subtle but different look here relative to this, and this. This also says be open to a breakout on the previous chart. This chart tells us it's possible we do have a major shift taking place relative to stock market leadership. Here's a successful breakout. The S&P 500 started to decline on January 3rd. So on January 3rd, we were still in this consolidation area. Since then, this chart has gone almost parabolic, and this is a breakout from a long-term consolidation pattern. Here's your left shoulder, a big head potentially, and a right shoulder. Talked about this in the past. These are the shorter-term trends, and they tend to be intersecting with longer-term trends on many charts. If we look at this energy index relative to the S&P 500 going all the way back, all the data that we have to the mid-1990s, once again, we're seeing a chart that RSI is at its highest level ever. That's not necessarily bearish, but it's good to be aware of. Here's XLE divided by SPY at the end of February. Had this white space here previously, we filled it. Now we'll learn something either way. Similar situation, energy versus tech. Obviously, a nice bullish breakout in here favoring energy. Now we're back to this downward sloping trend line. Not making any assumptions about what happens here. We'll see how it plays out. Again, speaks to interest rate expectations. We still have not exceeded this high here from last June on the XLF-SPY ratio. Very, very similar comments here, but this is a much longer term chart going all the way back to 2007. If we get the major shifts, you would guess that XLK is going to be the next area of the tech sector to fall. Currently, it's still holding this level here and this level here, and still hovering around an upward sloping trend line on the XLK SPY chart. If you're a stock market bull, this is the look you want to avoid. If you're a stock market bull, this is the look you want to embrace. This is an indecisive look in the present day. This is a very, very rare and powerful looking candle telling us to keep an open mind about this being a sustainable low. That also is to be determined. We are clearly still in a downtrend. NASDAQ price has been falling. You can make an argument that these are divergences here. Back of the envelope calculation says on Friday we might have landed somewhere in this area here. These are setups. We don't have any kind of follow through on the price chart yet. Still holding the breakout here relative to the long-term demographic and bullish thesis. This is your high fear deflationary look. This is economic fear in here. This is the present day. It's still holding this upward sloping trend line. S&P 500 here, a little backtracking after the major low. You can see this ratio here makes a lower high relative to this high. In the present day, we do have a lower high relative to this high, but we also have a breakout look here. Covered this in the past. We did get a close on the 10-month moving average the end of February, price-wise below. Simply tells us to be open to more downside, but history also tells us we should use a weight of the evidence approach and not get hung up on one input. Dow Jones Composite Index still holding this area here, this area here. This is the recent low. Very, very similar commentary relative to the Dow here. From a momentum perspective, a lot of white space up here. This does look weak, but for now, holding this level here, this level here, this level here, and this level here. Make a similar argument. What once acted as resistance, what once acted as resistance, what once acted as support, may now act as support. On all of these charts, we'll learn something either way. For now, most of them are holding, but they do look vulnerable. Always good to know where gaps are. Nothing definitive here at the end of the week. This still doesn't look good. And it's still clearly in a downtrend. If you're a stock market bull, you'd really like to see this area here and this area here hold. If you're a stock market bear, you like that this didn't hold and this didn't hold. Somewhat of a tweener look here, but near the inflection point, possible inflection point. If you've been doing this a long time, you know headlines like this are often followed by European stocks log their best week. That's not a prediction, just something to keep in mind. Worst week tends to lean towards overextended. Gold has been strong relative to the market since the first of the year, but this long-term chart and this look here relative to this spike here possibly puts it into perspective. Is it possible things are shifting in the credit markets? It is possible. It's very, very difficult to say that this looks good or bullish in any shape, form, or fashion. This needs to repair itself. It's possible this area here, same neighborhood as this look here on the small cap gap, possible you get a failed breakout look, but right now the chart in front of us, this doesn't look good. If you're a stock market bull, hard to make an argument that this looks good. It does not. Left shoulder, big head, small right shoulder. For now, this is a breakout in favor of defensive assets. Remember, I said mixed bag might be part of the theme in this week's video. Don't have a breakout on this one. SP low volatility relative to SP high beta, still consolidating in the box. If you pause your video player here, this is a high here near the major low in the S&P 500 that occurred on March 23rd of 2020. There's a high here, there's a gap here, and then you make a lower high after the major low in the S&P 500. You can make an argument, this look here, this is a smaller fractal here. If the ratio gets out here, you can take that fractal concept and toss it in the trash can. Not a good look for the bulls. You can make an argument this is not a good look for the bulls. This was that lower high look after the major low. The major low in the S&P 500 is down here. Still have a lower high here. Inflection point here for risk reward, risk on, risk off. Speaks to a possible inflection point for asset class leadership. Can make an argument that this look in here is similar to this look in here. In this case, bullish breakout in favor of RSP relative to SPY. Not a prediction, we'll have to see how it plays out. In last week's video, we talked about the reversal that occurred from the intraday low on Thursday, but we also noted that the short to intermediate term trend in the stock market was still down. That's still the case, and that's not particularly good news, but it might be surprising and a little bit encouraging given everything that's happened in the past week to 10 days or so. At the end of this week, the S&P 500 still finished 214 points above this intraday low here. The Nasdaq finished 726 points above last week's low, and the Dow is still 1,342 points above last week's low. This area is still a relevant guidepost. Not making any assumptions whether it will hold or whether it will be exceeded. If it's exceeded, depends how it is exceeded. To summarize, the short to intermediate term trend for the S&P 500 remains down until proven otherwise. The short to intermediate term trend for the VIX remains up until proven otherwise. These are not bullish bullet points. We covered some setups last week. We covered a few setups this week. Setups are worthless until you get confirmation or follow through. Haven't had that. I've had a bunch of 1 or 2 day wonders thus far on rally attempts. Probably the understatement of the week to say that the Russia-Ukraine timeline and outcome is highly uncertain. Obviously, a big spike in energy prices is not going to help the issue surrounding rising inflation. The key here is, how long do energy prices remain elevated? The longer they remain elevated, the bigger the impact on CPI. All of this is making the Fed's job more difficult, probably makes the stock market bear's job easier at this point until something changes. Very possible we are in the early stages of rate-induced shifts as far as asset class leadership goes. That's the value versus growth, the energy versus tech, and the RSP versus SPY battles that have been going on for some time. A lot of negative bullet points here, but these are the facts that we have in hand. Can't ignore the nimbleness bullet point. Things can change very, very quickly. Thus far, we have a market with no sustained bid, and that's relevant until proven otherwise. Extremely important that we wake up every day open to a wide range of outcomes. And we all know the only way any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.